Investor caution. The AI bubble. Time to reassess. AI's rapid surge shows early bubble signs. As of October 2025, experts from central banks and leading firms are raising concerns about potential risks. Let's review the key issues objectively so you can make informed decisions. The current rally relies heavily on a small group of companies. For instance, the Magnificent Seven account for 75% of the S&P 500's returns this year, driving the vast majority of earnings growth and capital spending. This concentration has driven 1.1% of GDP growth in the first half of 2025, surpassing consumer spending. Such dependence creates vulnerability, similar to the dot-com bust when Cisco's 80% decline contributed to the Nasdaq's 78% drop. Valuations in the AI sector have risen sharply. Many AI-related stocks now trade at price-to-earnings ratios 3 times the broader market average, approaching historical bubble levels. Interconnected investments like NVIDIA's stake in OpenAI, which in turn buys NVIDIA hardware, may support short-term prices, but raise questions about long-term sustainability. Despite $104 billion in funding for AI startups in early 2025, OpenAI projects only $13 billion in revenue against significant losses, compared to over $400 billion in annual capital expenditures across the sector. Reports from the IMF and Bank of England highlight these elevated valuations as reminiscent of past manias, with a higher risk of correction if AI adoption slows. Prominent voices are expressing caution. JP Morgan CEO Jamie Dimon has noted an elevated probability of a market downturn, given wasteful spending amid rising debt and geopolitical tensions. OpenAI's Sam Altman has described the market as a bubble, built on a foundation of real potential. The Bank of England points to AI firms' exposure to competition and delays, and a Yale survey shows 40% of CEOs worried about overinvestment. These perspectives come from credible sources worth considering. Potential triggers include interconnected failures leading to higher unemployment, regulatory issues around AI ethics, or technological shifts that make current infrastructure obsolete, much like the 1990s fiber optic overbuild. An MIT analysis found 95% of generative AI projects delivered no return on $30 out of $40 billion invested. Economic policy changes or global events could accelerate a downturn, potentially resembling a Cisco moment within 2 years. While AI holds genuine promise, overexposure carries risks. We recommend diversifying your holdings, preparing for possible 20% declines, and maintaining liquidity. Approach this with prudence. Markets reward the prepared. Review your portfolio today. Quick recap from 000450345. AI valuations ran hot and market gains concentrated in a few giants, patterns that echo prior bubbles. Diversify exposure and don't chase momentum. Action steps: stress test for 20% drawdowns, keep liquidity ready, and favor real cash flows over hype. Reassess positions now to reduce downside risk.